Okay, so I've got two lectures for accounting and finance for you. The first one is this one. It's going to be a bit more about terminology. Second one is going to be more technical. Both important. And so when we talk about funding in small businesses, you hear the terms finance and accounting. Finance is about the raising of capital, so getting money into your business. And then accounting is about the process and the processes that track how it's used. So your purchasing, your creation of financial statements, the actual bookkeeping that you do, that's all accounting. Finance matters because you need to know that you have enough capital to grow and survive. Accounting matters because you need to be able to track your performance, your cash flows, and you need to make sure that you're doing all of the things that you need to do to ensure legal compliance for things like taxes. And so both are equally important in two very different ways. That's how I would say it. So we won't cover this very much in this particular course, but I thought it would be important to explain to you what is really kind of gravity in the accounting world. I have crafted this course so you don't have to worry about the accounting equation except in one place, and that's the balance sheet. The accounting equation is basically assets equals liabilities plus owner's equity. Your assets are what you purchase, all of the things that you own. And because I own an iPhone for my business, for example, I have used some of my personal savings to purchase that iPhone, and I'm converting it to a business asset. So I have an asset, and I've also created some equity by putting my own money in the business. So I have a I know iPhones don't cost $500, but a $500 iPhone and $500 in capital. Okay, so there's my assets equaling liability plus owner's equity. In that instance, my liability is zero because there's no loan involved in me purchasing an iPhone. Now, let's say that I go out and I purchase a car for my business. So the car is going to be maybe a $30,000 asset, and let's say I'm paying, I have a loan against the car. That loan is a $30,000 loan. So I've got $30,000 on the asset side, $30,000 on the liability side, nothing for owner's equity because the car is already, I don't own the car, I'm paying it off, but the car is a liability. And so you'll probably get a little bit more of that in the accounting itself lecture, but I just want you to be aware of the accounting equation because you might hear it from time to time. And like I said, this is more a terminology lecture. So I just want you to know what it is. Assets equals liability plus owner's equity. For business folks, that's like, or for accounting folks especially, that's like gravity. 3 financial statements that you are going to be learning about, plus one more. I'm going to talk about the plus one more in a minute. The income statement, balance sheet, and statement of owner's equity are 3 basic accounting statements, financial statements that you will be creating in this course. They are the most common for small businesses. And then there's also the statement of cash flows, which is a little bit more advanced, so we don't cover it in this class, although I will tell you what it is and what it does. Let's start with the income statement though. The income statement shows your revenue and expenses over time, and you use it to calculate your net profit or your net loss. The income statement is the statement that answers the question for you, how's business? Because you can look at your income statement and you can say, well, I had $10,000 in revenues last month and I had $8,000 in expenses, so I made $2,000. How's business? But at least it's net profit. If I made $8,000 in revenues and I had $10,000 in expenses, then I lost $2,000 and we would call that net loss, and that would not be great. But again, more in the accounting lecture on that. The balance sheet is a snapshot of assets, liabilities, and equity over a specific time. Your balance sheet is your visual, is your financially, it's your visual representation of the accounting equation. So what you will notice in the balance sheet when we go to the accounting lecture is the assets on the asset side always have to be equal with the liabilities and equity on the liabilities and equity side. So the left side has to equal the right side. That's gravity in your business. And then the statement of cash flows, the way that I describe the statement of cash flows is it basically measures the flow of money through your business, through what you're putting into your operations, what you are investing into your business, what's coming out of your business, and what you are using the money in your business to finance. So it kind of tracks how you're using your money in your business. Really important for investment purposes and investors, but it's a little beyond the scope of our class. We do have a course, Business 154, that does go into the statement of cash flows. And then when we look at accounting and you're accounting for your small business, most of you are probably going to be doing what's called cash accounting. And cash accounting basically just means that when you take a dollar in, that dollar goes into the bank, you recognize that it's in your accounting system, and so it's all happening. It's accounting that's happening in real time. You're accounting for your cash in real time. Accrual accounting records cash when it is earned or incurred. So for example, in my Airbnb business, I can, for example, if I choose, when somebody books in for me in July, and let's say that they've booked it the prior May, well, I can say that I have earned that revenue, or I've made that revenue, but really it's not into my pocket until they actually use my place and book it. And so accrual accounting is when you recognize your revenue when you earn it, not necessarily when it comes cash in hand to you. I always think about like selling season tickets, like baseball season tickets, like you pay up front for your season tickets, but really the baseball team isn't earning those revenues until the game that you use the ticket for. So maybe that's like 6, 3, 5, whatever, how many months away. That is accrual accounting. When we look at cost and cost behaviors, this says cost types. I like to think of costs as they behave in your business. And I, again, have more in the accounting lecture for each of this. I just want you to be aware of the terminology and the vocabulary. Fixed costs are costs that stay constant. They don't change with the level of business. So if I'm paying rent, for example, I'm going to have to pay rent whether I do a lot of business or a little bit of business, because my rent is always going to stay constant. Variable costs change with the level of business. So for example, my employees, if I have 3 employees working in my coffee shop and it's slow, I can send 1 home. Or maybe it's busy and I need to call 2 more in. And so those costs change with the level of business. An employee on salary where I'm paying them a fixed amount no matter whether they work or not and they have a salary, they would be a fixed cost. But just about everything else, your materials costs, most of your costs tend to be variable in nature. Break-even analysis is probably one of the most important tools that you will have and use. And that is your break-even is the point at which your total revenue equals your total cost. After you hit break-even point by 1 unit, you have moved into the profitability area. Okay, so break-even is a very important point in time, and it's a very important amount that you sell or products that you sell. Usually you calculate it by either dollars earned or products sold. I like it by products sold because I know if my break-even point is 50 products, I'm making profit at 51. And then moving on to sources of funding. We have talked a lot about using personal savings as capital and starting up a business with personal savings. Technically, that's referred to as bootstrapping. So when you hear somebody talk about bootstrapping, they're simply saying that they're putting their own funds into the business and they're using those funds. It's a very lean method to start a business or fund a business. Debt is going to be any kind of loan that you get. It's money that you borrow that you have to pay back. So if you fund your business with bank loans, credit cards, don't fund your business with credit cards. Like find cash. Like they're going to be, that's the worst interest rate you can get. Also payday loans, worst interest rate you can get. Don't do either of those. But a bank loan, if you can get one, would be reasonable. Equity is raising capital by giving up ownership. So you have an investor, and the investor is investing in your business in exchange for some shares of ownership. In exchange for those shares of ownership, you're also going to give up some say-so, right? Because they're an investor now and they own a little bit of the business. They have a right to share their opinions, and you might have to give up some decision making. When you see shows like Shark Tank, the investors on Shark Tank are investing through equity, not debt. Sometimes you can find funding through grant sources. And grants are non-repayable funds. A lot of times they're tied to specific goals. So it might be a grant for a social type goal. It might be grants for nonprofits. It might be, so my brother has a sport fishing business, and from time to time, the state of California will offer grant funding for things like making the boats more efficient. And so if he decides that he's going to make his boat engines more efficient, and he signs a contract to that, the state of California will chip in $50,000 to help upgrade his engines. And then a lot of times you can fund your business once you start, and this is always a great idea, once you start up the business and you start, maybe you're bootstrapping and you get things going, then you're going to use your revenue to fund your operations. So revenue funding is basically when you're just generating your revenue and putting that back in the business to help it scale, which is always a good idea. I've talked a little bit about angel investors, but technically angels are high net worth individuals who invest in, who give you early stage, so they're for early stage, that seed money to get you started up so you can get to that minimally viable product point, or so that you can launch into the marketplace. Once you've launched, then you generally move on to venture capital, and these folks are professional investors who fund startups with high growth potential. A venture capitalist is not going to fund my Oceanside coffee shop. An angel investor is probably not going to fund my Oceanside coffee shop. That's going to be a friends and family thing, although I may, if I have something unique, be able to get angel funding for that. I probably wouldn't ever get venture capital for something like that. I might try to get crowdfunding, and crowdfunding is the process of raising small amounts from lots of people online. It tends to be peer-to-peer, things like GoFundMe, Kickstarter. Those are types of crowdfunding mechanisms. There's a couple more out there. Indiegogo. Oh, and there's one I can't think of. Oh well. Some additional vocabulary and important considerations. I've talked about your cash runway, but I don't know that I've talked about your burn rate. Your burn rate is about how quickly you're spending your cash before your business becomes profitable. An investor is going to look at your burn rate pretty significant. A potential investor is going to look at your burn rate what's the word I'm looking for? He's going to pay close attention to your burn rate. And then your runway is your cash runway, which is the time that you have that you can operate before you're going to need to raise additional capital. Okay, so that's your runway. Generally, you want to have, like in a small business, 6 months to 18 months cash runway, especially if this is something that you're quitting your job for. You want to make sure you have about an 18-month cash runway. And ultimately, you want to make sure that with all of your business, all of your accounting and your finance, that you are accurately tracking what comes into the business, how you're accounting for everything, and what goes out of the business, both for your investors and for tax compliance. I was going to add something else there. Oh, yeah, I'm going to add that here. And as you are making your sales and operating your business, being accurate and consistent with your accounting is going to help you so much in the long run. I try to do my accounting once a month. I dedicate some time on a Friday for it. It helps because I remember all of those little things that I spent money on that I would normally forget. And when it gets to the end of the year, I have all of my stuff ready for my tax person, and it's ready to go, and I can just give it to them, and then they can do all the magic that they do with the IRS. Some concluding thoughts. Finance and accounting are essential to launch, sustain, and grow your business. The more research you put into your cost structure, the more prepared you will be. I promise you that. Also remember that investors are realists and will scrutinize your financials. So you want to make sure that your financials are accurate and you can support the assumptions that you make in there.